John, let's kick off with the key factor of all the banks' earnings and the interest rate environment and the relatively soft net interest income guidance. For your guidance, what are you using as your base case for rate cuts in the year ahead? And to what extent is there room to offset lower rates with lower deposit rates, given that they weren't really hiked that much during the rate hike cycle?
Yeah, that's a good point. So as it relates to interest rate forecasting and what it means for net interest income, we run scenarios these days between 1 and 3 moves by the Fed, and whether it's a 50 basis point and a 25 or 325s, some version of that fits into our current guidance, which is at the low end of our call of down 2 to 5% for interest income for the year, and halfway through the year, that feels about right. The bigger picture, though, is it's deposits, as you said, and what we pay for them, and what we're earning on the asset side as well. In the second quarter, setting ourselves up for the rest of the year, we had a $6.2 billion worth of net income. We generated more assets, more loans, and more deposits than we had a year prior. A lot of the business fundamentals actually are feeling really strong. So another part of this story is if these rate cuts do actually extend the recovery that we're in, what are the benefits for banks and for bank earnings as a result of having softer credit, having a stronger consumer, having a consumer spending for a longer period of time, and keeping borrowing costs low, which encourages people to spend and invest at the margin. All of those things factor in. You asked a question about deposit rates, and you're right. They had not moved up. Oh, go ahead.
No, you go ahead.
Yeah, the question of what happens to deposit costs, given that they had not fully reflected where you might have expected them to go after a few years of Fed rate increases, means that there is less room for them to go down on the other side, and that's what's leading to this expectation of margin compression. And I think all of the banks are signaling that there'll be some element of that, depending on what their deposit base looks like and how low they can bring rates, depending on what their depositing customers are demanding, given alternatives.
John, the other reason I think the share price is down today, based on analyst commentary, was from the earnings call, the fact that you guys lowered the amount of cost savings you might be able to deliver in the next 18 months. What's happening now? The government making you spend a fortune on compliance?
No, there's two things. We have efficiency programs that have been in place for the last couple of years, and whether it's taking advantage of our scale where we have it, or the change in the business that's leading to more self-serve and automation and other things that make us more efficient, that on the one hand. But there is this need to build, both in our risk function as well as in all of our businesses, more complete and robust risk and control capabilities, all of which have a component of technology that supports them, and those have been expensive. And as we've gotten further into it, as we've added more leadership in those areas, they've continued to be more expensive than we had originally forecast. So we're operating in the low 60% efficiency ratio today. We should be in the high 50%, optimally in the mid to high 50%. It's going to take us a little bit longer to get there, but what we're spending money on is making us a better company. It's making us better controlled. And it gives us a path to being as efficient as we can be on the other side. But you're right, that was disappointing to our investors.
John, on the call, your interim CEO, Alan Parker, addressed the point that he is still the interim CEO and whether or not the board was considering him as permanent CEO. Let's just take a quick listen.
When the board asked me to take on the interim role, I assured them that I would do the best I could in the role for as long as they needed me. And that's really what I've been focused on, trying to move the company forward together with the operating committee to the best of my ability. But from the very beginning, they said they were going to be seeking someone from the outside. And as far as I know, they've never wavered from that.
John, there's been a number of reports that the job has been offered to people on the outside. Do you have any idea why they haven't taken the role?
I haven't heard that. In fact, I read the news as well. I'm sort of taking it from our board chair in particular, who's making the point that the committee is working hard. This time frame that we're under, frankly, from my perspective, having recruited senior people, not CEOs, but into our organization, it takes a little bit of time, and they'll get the right person. I think Alan is doing a great job in the interim. He's doing the exact job that they asked him to do, and it has been clear from the beginning that they were looking for somebody from the outside for the reasons that they described at the time. So I think it's a great job. It's certainly a great company. It's a big opportunity for somebody, and they'll find the right person.
John, I want to go back to the comments you just made about investing in technology. What do you think, or I guess what is the Wells Fargo vision for consumer banking in the future, especially as we talk about digital tokens, as we pay more and more attention to startups that are venture capital backed, that are taking out banking charters? What does this sector look like, and what would somebody like me as a consumer, what would that experience be in the coming years?
Sure. So whether it's legacy banks like ours or many of the people in the ecosystem of fintechs who are contributing to or competing with banks for customer business and changing the experience, it is all about convenience for the customer. It's about access to your information, access to your assets, doing things in one place. Sometimes it's a la carte, but you probably want it all on your phone. I think increasingly the demands for personalization, so that it's clear that what your bank knows about you is brought to bear in how they respond to issues that you have, in how they describe and promote value for you, that you never have to tell them something that they should already know, and that they can anticipate where you are in your earning, in your spending, in your saving for retirement, et cetera. All of those things are part of the current and next-gen banking experience, and those are the areas that we're focused on. As it relates to the fintech charters, I will be interested to see how some of these companies who operate in a lightly regulated environment manage to navigate through what, for a lot of good reasons, is an increasingly complex regulatory environment as things like privacy become bigger issues on top of the consumer experience, on top of law enforcement, on top of money laundering, all sorts of things that come to bear as part of being a financial services provider. And all of that has to work in a very seamless and contextual experience for the customer.